This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com, and I have with me this morning a couple of noted and well-recognized writers on the web. No stranger to our regular listeners is Charles Hugh Smith, author and publisher of the website of2minds.com. Also joining us today for the second time is Lance Roberts from Houston, whose investment strategies and knowledge have been featured on CNBC, Fox Business News, as well as being quoted fairly regularly by a litany of publications. Welcome, everyone.
Thank you. Good morning.
Good morning.
Good morning, Gordon.
Lance, maybe we could begin by you giving our listeners just a very brief introduction of your writings, things you're involved with, for those who may have missed the first show we had with yourself.
Sure, absolutely. Basically, I'm a wealth manager here in Houston, Texas, and we have been managing money now for about 25 years altogether. And our primary focus is on individuals with, basically moving into retirement or in post-retirement type planning strategies. And our philosophies are really built around long-term market analysis, principal conservation, what really works in the markets, and what we say often is how money really works. That's kind of our key driver for our listeners, and as well as far as our investors. I host a daily radio show as well as run our own blog site at streettalklive.com.
Charles and I asked Lance to join us this morning because though we pointed out in our last session that there may be some very serious economic issues on the horizon, this may not necessarily correlate with what the financial markets or the equity markets may do. The simple facts are that they have diverged from any and all historic measurements because of this extraordinary global monetary policies that's going on. So the question on the table is Dow 20,000 on the horizon, or is it Dow 5,000? Which one's it going to be? And clearly, nobody really knows, but we're going to go around the table and talk about that this morning. These slides are for discussion and educational purposes only. Do not trade from any of these charts. The participants are not giving investment advice, nor should it be construed as such. And always consult a professional investment advisor before making any investment decisions. Having said that, all three of us have spent a lot of time pondering and writing on the current economic and financial environment. Therefore, thought today we would simply go around the table, share our views based on our research, at least as of today, because one thing we can be assured of is that things will be different to tomorrow. This show is unscripted, so we'll see if we have any sort of consensus at the end of it. Lance, maybe we can start with you. Is it Dow 20,000, Dow 5,000, and when?
Well, I think this is a key point that you're bringing up, and I'm actually glad we're doing this because one of the problem that the three of us kind of have is that we generally kind of agree that economically things do not bode well for the future. I mean, if we look at everything from valuations to corporate earnings to what's going on with government debt, spending, etc., we can all make a very good case that Dow 5,000 is far more probable than Dow 20,000. But the important thing as investors and as money managers, as individuals, and just as thinkers, is that we always need to ponder the other side of the case so that we don't get trapped into what's called confirmation bias. So kind of my thoughts are here is, to make sure that I'm not being trapped into my own thought process, what are some of the reasons why we could actually see Dow 20,000 before we see Dow 5,000? Let's make the bullish case for a moment just to see if we can build a case that actually counteracts the more bearish case of the evidence, or what I believe to be the weight of evidence that lies before us. So my thought process are, really, economically, I can't provide a case for Dow 20,000. And as you just correctly stated, the price of the market has diverged from the underlying economics. Fundamentally, valuations on a trailing basis, etc., are really at levels that we haven't seen in the last 25 and 30 years. So on a fundamental basis, I really can't justify Dow 20,000. So what would cause the markets to surge to Dow 20,000? That would be the psychological impact of investors reaching into the markets in terms of what we call a phase 3 of a bull market. In our opinion, there are 3 phases of every bull market. And going back to 2009, when the market bottomed in 2009 and begins to take off, most investors have been hurt so badly at that point. They have lost so much money. They've sold out they've panic sold at the bottoms. And now they're going, what bull market? This is just a crash before, it's just a bounce before the next crash. That's all this is. This is a sucker's rally. Well, then the markets keep going because the Federal Reserve is pumping in trillions of dollars worth of capital and the government's bailing in the markets and the economy from all different angles. So the market keeps going. And then eventually we get into phase 2 of the market, which is where they go, well, all right. This is actually, the market is recovering, but it's I've already kind of missed the bottom, so I'm just going to wait for a pullback because the market's going to pull back, but it doesn't. It just kind of keeps rising in a steady trend. I mean, you do get some pullbacks along the way, but they're minor. They're only pullbacks to trend. And of course, a lot of these investors are still sitting on the sidelines in cash, trying to figure out if they should get in, and they still try to convince themselves that the market is still just bouncing from a bottom and that this is not going to last. But then we get into, and by the way, that's where we are now. Investors are still not convinced. We've seen plenty of articles written about how this is the most hated bull market ever and the markets are going up. But phase 3 is where all these individuals that have been sitting on the sidelines holding cash, they finally just capitulate and they throw their money into the markets. And of course, what you've seen this year in 2013 with the advent of QE3/4 is we've seen massive inflows into equity funds this year, and we've seen outflows out of the more conservative areas such as bonds. And you're seeing that reversion. And this is where investors just finally give up and they figure out that the market's just going to go up forever and you just have to get in because it's never pulling back again. This time is different.
Words that cost everybody the most money in the markets, right? This
That's
time
right.
It's different. But it reminds me really clearly of 1986, the fall of 1999, and there's probably some others where it just kept on going and going, and the bears got beat up so badly that finally everybody just capitulated, threw in the towel, and it wasn't long after that before everybody got their heads handed to them. But it always seems it goes on way longer than anybody can conceive or believe.
The old saying by John Maynard Keynes, right? The market can remain irrational longer than you can remain solvent. And unfortunately, that's kind of the case. I mean, we've seen some of the most noted bears, what they call perma-bear, people like David Rosenberg flip the coin and go very bullish now. And you're seeing that capitulation, kind of all across the mainstream media outlets as well, which is now there's no longer any worries about caution. And I just recently went to New York, and I spent a week in New York talking to various individuals, and I asked them all the same question. I said, what is it that causes this market to fall? The same answer, I go, can you give me a fundamental or an economic case why this market's going to keep rallying? The only answer they can give me why this market is not going to fall is the Fed. We have one item pushing this market. In 2000 and early 2008, it was March of 2008, I was in New York meeting with hedge fund managers, and I asked them all the same question. What is it that keeps you up at night? The answer was nothing, because we're so well diversified. We have so much of our positions hedged off with either CDSs or CDOs or CMOs that we don't have to worry about any risk. We're so diversified, we diversified our risk out of the portfolio. Of course, it was just 4 months later that the wheels came off the cart. So, at these market peaks, we always see the same type of analysis. Well, as long as the Fed is in the game, we're okay.
There's always something, right?
Yeah.
Lance, I used example 86. It was something called portfolio insurance back then, which is the precursor to dynamic hedging. Gets into your comment about hedging. But everybody was convinced that things had changed differently. 99, it was things are different because technology is reinventing all of the metrics. There's always a reason. I've noticed with these, exactly the same, the perma bears, one after the other falling, but at the same time, I've noticed, I'll use the word Cassandras that are appearing, which are people that you've never thought to be negative. They're not market followers. They're more economists, macro people who are becoming negative and aren't the type that are negative. They just see so many major structural issues. And the other day I saw the Treasury talking about that the consensus is so consistent, they're concerned about everybody being on the same side of the boat, that the Treasury was actually warning of this problem. I think you even wrote about it.
Yep. It is certainly something when the Treasury Department's coming out and making, market calls. That is something that's going to be worrisome of.
Well, why should they be any different than the Federal Reserve in trying to control the market? So it seems that's new government policy. Anyway, I'm getting us off track.
And this is the idea here of what drives the markets in general, is that there is about an 80% correlation between the Federal Reserve balance sheet and the movements in the market since 2009. Prior to 2009, excess reserves and for banks as well as the Fed balance sheet were very low levels. Of course, this is completely skyrocketed. Now, the question becomes, if we're moving into what I believe is going to be the Japan syndrome, which is basically you cannot stop the liquidity. It's a liquidity trap. You can't stop putting liquidity in, because if you do, then all the economic recovery you're getting ends and you get a reversion. So if this is the case, and we continue to see the Fed trapped in this position where they have to continue to input capital into the markets for an extended period of time, this is what would be a driver of pushing the Dow to 20,000. And this is probably the only real case that I can make at this point for getting us to Dow 20,000 is simply a function of it really is all about the Fed. But the issue is, as we move into the next slide, which is really showing these three phases of the bull market that we talked about just a second ago. What bull market is there? I missed the bottom. I'll just wait for a pullback. And then this is going up forever. You just have to get in. The three different phases. I've actually identified the three different phases that we've seen in the markets since 1994. And you were just talking about the 1999 bubble. Of course, we saw the same thing in 2005, 6, and 7. And then we're seeing the same thing now. When we get into, and you'll notice in the top chart, the top part of the chart is an indicator that shows extreme overbought, extreme oversold. This is a monthly chart, by the way, so this strips out a lot of the short-term volatility of the market. No matter where you look on this chart, we are at levels that are normally more consistent with market peaks than we are with the beginnings of a secular bull market. This has been one of the conversations I've heard thrown around quite a bit, is that, this is the next great secular bull market that we're entering into. Secular bull markets don't start from these type of both price extension levels as well as fundamental valuation levels. You don't start secular bull markets at 20 times trailing earnings. That just doesn't occur. It's never occurred in history over the last 120 years. So you're not going to see a secular bull market from here. The valuations just simply don't support it at this point. And again, and then finally, just kind of nailing that point, the next slide is our economic output composite index. And I recently did a study that I posted on the internet and on our blog site as well, talking about economic growth. And I took economic growth going back to 1850 and then ran it forward into major cycles, where we were going through, for instance, the boom in the 20s leading up to the crash of 29, the boom in the 40s, 50s, 60s, as we were coming out of World War II and we were rebuilding the entire world, the booms in the 80s and the 90s. Now look at all these different, those periods in economic growth. Right now, since 2000, we are running the lowest level of economic growth ever in recorded history on an annualized basis. And what this economic composite index is this is a look at all different types of economic output composite surveys, such as the Federal Reserve manufacturing indexes from Kansas and Dallas and Philadelphia and New York, as well as the Chicago PMI, the Chicago Fed National Activity Index, the National Federation of Independent Businesses, the ISM surveys, both manufacturing and non-manufacturing, all compiled into one economic index. And there is a very, very close correlation between this economic output composite index and GDP, which you would expect to see because these are all measuring the same thing. But what you notice here is that we have seen these recurring periods of economic strength over the course of the last 4 years. And each bounce has led to expectations that we're about to launch off into the next great period of economic growth, and of course it fails. And we have a soft patch. And then we have a recovery, and that's going to be the next, we're on the road to stronger economic growth, and then it fails into a soft patch. But notice what is the most important thing here of all this data is since the peak in 2009, we have been in a steady decline in economic output. So for outside of the Federal Reserve boosting up balance sheets, and the reason that the case I'm making for Dow 20,000 is a continuation of the Fed boosting the balance sheet is simply because that economic growth is not sustainable without those Federal Reserve interventions. In other words, they are caught in the liquidity trap. They cannot get themselves out of it because if they do, you're going to have a recession in fairly short order. And we are teetering on that real issue now because of this government shutdown and the potential of what's going to happen in the next 14 days with the debt ceiling debate, that we could very well see a contraction in economic activity going to the end of the year that could put us on the brink of a recession if we're not very, very careful. But this is why the Fed is not going to be able to taper this year, and we're doubtful that it will see any real tapering probably moving into 2014 before the next set of elections.
This liquidity trap that you're referring to, Lance, we've done a number of shows are up in the library on the globalization trap that shows this decay in economic growth that mirrors globally what you're pointing out in the United States. In fact, we're at really, I believe, at negative real growth rates on a global basis. So the problem isn't just unique to the United States, and so it feeds off itself right around the world.
Absolutely.
And clearly, I believe, is accelerating, and we saw that in the recent problems in emerging markets. The tremendous difficulty they had immediately that taper began to be talked about in May and June. Their currencies went south. They were immediately having to sell currency reserves to shore up their currencies. Those currency reserves are held typically in U.S. treasuries, and therefore the bond prices started going up, which in itself was creating, as we all know, serious issues. It is so interrelated and so interconnected that we can't even any longer look at obviously the United States market in isolation.
Right, and look, and Gordon, that is the most important point that I think you could make here, because remember when interest rates spiked back in May and June, the argument was not, oh, well, this is because of emerging market countries having to, sell bonds to rebalance their currency reserves, which was an argument I was making as well as you. But it was, this is evidence that the economy is set to recover, and the reason that interest rates are going up is because the markets are now betting that the economy is on a path of recovery.
Wrong.
And I was arguing till I was blue in the face that this was not going to be the case.
Clearly wasn't. As a matter of fact, Lance, I would argue that at the G20, though the press was all caught up about Syria, the real issues that were going on were the magnitude of the slowdown globally. The BRIC countries, the three of them at least, Brazil, India, and South Africa, the problems they were facing, they were cobbling together $100 billion reserve funds to be able to fight this right at the G20, announcing the development bank, the acceleration of another $50 billion there. Never mind then going into the main tent where they were talking about Syria, and were totally opposed to it because of what it meant economically around the world. None of that seemed to get any of the press. And then, of course, right after the G20, what did we have? We had some of the most major reversals we've ever seen. One, Summers withdraw, and suddenly everything reversed, it seemed, in the emerging markets when Summers, who was going to be less of a hawk printing money than Yellen, at least it was perceived. And then immediately we had the president defer to Congress the decision on Syria. Then immediately we found another resolution to it. Things that changes that we've never seen before, and then the Fed reversed course. We have never seen things like that appear so quickly and so rapid fire. And what it did is it reversed, at least temporarily, the magnitude of the problems that are facing in these peripheral countries that haven't got the growth and they can't add the value, and they're facing just horrendous problems. And I call it the echo boom, and it's still to come. We are breaking this session at this point and will continue on tape number 2. We have a very large audio and iTunes listener base who have requested that the sessions be kept to approximately 20 minutes in duration. We'll be right back.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recording